Going from $10,000 to $100,000 takes most investors between 7 and 12 years. Going from 100,000 to 1 million, about the same amount of time. That is not a typo. That is compound interest operating exactly as designed. And almost nobody ever experiences it because they exit the ride during the slow first climb, right before the vertical drop. But here's the layer that doesn't make it into the headline. There is a specific dollar amount, not 1 million, not some vague financial freedom threshold, but a very specific number I'm going to give you in this video, where your portfolio begins generating more passive annual income than the median American household earns working a full 40-hour week. That's the actual target, not the $1 million headline. That number and the math behind it changes how every financial decision you make today should feel. I've spent the last decade running my own business, surrounded by accountants and fiscal lawyers who showed me how money actually moves at the institutional level, not the sanitized version from a personal finance textbook. I've got multiple hundreds of thousands of dollars in the market right now. Skin in the game, not a whiteboard exercise. And the most important pattern I've observed over a decade of watching wealth accumulate mine and others is that almost every financial mistake people make isn't a math problem. It is a brain problem. People know what to do, they don't do it. Understanding why that gap exists is where the actual edge lives. Here's what this video covers. The real math behind going from $10,000 to $100,000 and why your intuition about the timeline is probably backward. The 3 specific dollar amounts where your portfolio's behavior changes entirely. Why the jump from 1 million to 2 million happens in a fraction of the time it took to build the first million, which sounds implausible until you do the arithmetic. And the psychological wiring that causes smart, disciplined people to quit compounding right before it goes exponential. By the time we're done, you'll know exactly which phase of the journey you're in, what changes at each threshold, and why the boring strategy beats everything else so consistently, it should make you suspicious of anything more complicated. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Before anything else, I need one metaphor, because compound interest is genuinely difficult for the human brain to internalize without something physical to hold on to. The moment I start throwing percentages and time horizons without grounding them in something concrete, I lose you to your phone. So here's the one I always come back to. You're at the top of a long mountain. You pack together a handful of snow, softball sized, barely holding its shape. You set it down and push. First rotation, it picks up almost nothing. The surface area is tiny. You are doing all the work, and the ball is barely changing. Second rotation, same story. Third, same. By rotation 10, it's basketball sized, and you can feel the faintest hint of momentum starting to contribute. By rotation 50, the thing is enormous, picking up entire sheets of snow with each turn, moving faster than you can keep pace with it. By the time it reaches the bottom of the mountain, 90% of its total mass was accumulated in the last 20% of the journey. That is compound interest. And here's the part that actually matters. Nobody tells you which rotation you're on. You're pushing your softball in month 36 of investing, assuming you're still at the beginning, when you might be approaching the point where gravity takes over entirely. So people quit. They cash out, buy the nicer car, move to the bigger apartment, take the vacation they couldn't wait for. The snowball stops rolling right before it would have started moving entirely on its own. Every concept in this video maps back to this mountain. If you leave remembering nothing else, remember this. The people who build real wealth are not smarter or luckier than the people who don't. They are simply still pushing when rotation 50 arrives. In a few minutes, I'm going to show you the exact dollar amount where your annual portfolio return first exceeds your annual contribution the moment your money officially works harder than you do. But first, let me show you why the early phase of this journey is more psychologically brutal than anyone on the other side of it will openly admit, and why that brutality is actually a diagnostic signal that you're doing it correctly. There's a famous chess story. A king loses a match to a master and offers any reward. The master asks for a grain of rice on the first square of the chessboard, doubled on every subsequent square. 1 grain, 2, 4, 8, 16. The king laughs. It sounds almost insultingly modest. His advisors go pale immediately because they understand what's coming. By the 64th square, the king owes 18 quintillion grains of rice, more than has ever been grown in the entire recorded history of human civilization. He is bankrupted by a debt that started with a single grain. He lost because he was running linear intuition on an exponential problem. His brain said, it starts small, it stays proportionally small. The math said something completely different, and he didn't consult the math. Your investment account is that chessboard. The first 10 squares feel meaningless. The last 10 squares are where the math becomes almost surreal in your favor. The question is whether you can stay at the board long enough and whether you can resist the very human impulse to cash out at square 12 and call it a win. Here are the actual numbers. You start with $10,000. You add $500 per month to a Vanguard Total Stock Market Index Fund VTI. You earn 7% annually. 7% is the inflation-adjusted historical average of the S&P 500 going back to 1926. Not a crypto projection, not an optimistic assumption. 100 years of real market data applied conservatively. Year 1, you contributed $6,000. Account balance, roughly $17,200. Market returns earned approximately $900. You sacrificed $500 every month, said no to things, stayed disciplined through every paycheck, and the market handed you $900. Your coworker took a weekend trip to Nashville, bought an air fryer he uses twice a week, and started a skincare routine he read about on a subreddit. He seems completely unbothered and does not think about money very much. Year 5, total contributed on top of your starting $10,000, $30,000. Account balance, approximately $56,000. Returns generated roughly $16,000. Better, but you are still doing the heavy lifting. The snowball exists. You are very much still pushing it. Year 8, you cross $100,000. At this exact moment, something structurally important happens. At $100,000, at 7% annual returns, your portfolio generates $7,000 per year in passive growth. You are contributing $6,000 per year. Your money just became more productive than you are. You go to sleep, your account generates more than your monthly deposit. You attend a meeting nobody needed, your account generates money anyway. The snowball is starting to push back. But here is the most important reversal in this video. And I want you to lock this one in. You think the problem that stops people at 100,000 is mathematical, that the growth looks slow, the timeline feels long, the numbers feel inadequate. That is not the problem. The math is fine. The problem is psychological. People hit 100,000 and one of two things happens. Either they treat it as a destination, ease off contributions, lifestyle inflate, reward themselves for the years of discipline, or they do linear extrapolation. It took me 8 years to reach 100,000, so the next 100,000 will take 8 more years. I'll be in my mid-60s before this matters. They get demoralized by a projection that is completely wrong. From 100 to 200,000 takes roughly 5 years with the same contributions. From 200 to 300,000, about 4 years. From 3 to 400,000, around 3.5. The gaps compress because you're compounding from a larger base every single year. The acceleration is real and relentless. It's just invisible when your brain is running linear math on an exponential function, which is exactly what human intuition does by default, and why smart people make this specific mistake consistently. Now, let's put a dollar figure on what that intuition error actually costs, because I don't want this to stay abstract. If you're 30 years old and start investing $500 per month today at 7%, by 65, you'll have approximately $1.3 million. Wait until 35 to start, same amount, same returns, you end with $910,000. A 5-year delay costs you nearly $400,000 in final account value. You only contributed $30,000 less over those 5 years. The other $370,000 is the compounding you forfeited. Every single dollar you chose to spend rather than invest during those 5 years cost you $37 in future account value. Nobody puts that exchange rate on the receipt. Wait until 40, $620,000 by 65. You've lost nearly $700,000 compared to starting at 30, not because the market punished you, but because you gave the early rotations of the snowball to time and walked away before the momentum built. Here's something worth sitting with for a moment. The $370,000 you lose by starting at 35 instead of 30 is not money you decided to invest and lost in the market. It's money you spent on things you probably can't clearly recall anymore. Dinners that were fine, upgrades that felt urgent, subscriptions that quietly lapsed. The opportunity cost of forgettable consumption is extraordinary. And because it's entirely invisible, nobody ever actually feels it. Until they're 58 and their colleagues are panicking about a restructuring and they are not. Now, I want to introduce something that's going to run through the rest of this video because the math only tells part of the story. And the part that actually changes behavior is usually not a percentage. I know a property manager, let's call him Marcus. Mid-level regional real estate company. Solid but unspectacular career. He started automating $500 per month into index funds in his mid-30s, kept going through the 2008 crash, and bought shares the entire way down, while his financial advisor at the time strongly suggested otherwise. He kept going through 2020. 14 years. Not a single interruption to his automated transfers. By his late 40s, Marcus had built approximately $680,000 across his brokerage and retirement accounts combined. His boss, for a significant portion of those 14 years, was the kind of manager who schedules Sunday afternoon calls to prove he can. The kind who CCs the entire regional team on a correction written specifically to sting rather than instruct. Marcus had complained about this person for years. And for years, he had no real options, so he absorbed it. Then one Sunday, the email landed. Marcus didn't reply that afternoon. He opened a spreadsheet instead. At 7%, $680,000 generates approximately $47,600 annually. His living expenses were roughly $55,000. Not free yet, but close enough that a part-time remote consulting arrangement would cover the gap while his portfolio kept compounding untouched. Monday morning, he replied, professionally, clearly, with zero subtext of accommodation or fear. His boss backed down entirely. Not because Marcus said anything threatening, because Marcus stopped sounding like someone who needed the job. Experienced managers can read that shift the moment it appears. They always can. We're coming back to Marcus before this video ends. But right now, I want to walk through the second inflection point where this stops being interesting math and starts being genuinely life-altering. The second inflection point is $650,000. At 7% annual returns, $650,000 generates $45,500 per year in passive growth. At 8%, $52,000, the median household income in the United States as of early 2026 is approximately $78,000. Your portfolio sitting there, doing nothing you could call work, is generating between 58 and 66% of what the median American household earns by showing up every day for an entire calendar year. You are being partially compensated by your past self's decisions rather than your current labor. That is not a subtle change. That is a structurally different experience of money, work, and time. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. This is also the level where your relationship to market downturns completely inverts. Your portfolio drops 20% in a correction. On paper, you've temporarily lost $130,000. Financial news is catastrophizing. Your brother-in-law is forwarding you articles. And here's what's actually happening at the same time. Your $500 monthly contributions are now buying shares at a 20% discount. Every month during the crash, you're buying the same underlying assets on sale. And historically, not occasionally, not in most cases, but in every recorded instance over any sufficiently long time horizon, markets recover. The investors who kept contributing through 2008, buying shares at 30 and 40% below peak, while everyone else was either frozen or actively selling, dramatically outperformed people who started cautiously in 2010 after the recovery was already baked into prices. Not because they were prescient, because they understood that temporary scarcity is not permanent reality. There was a farmer during a severe regional drought. Every farmer around him was hoarding seed, too afraid to plant when they might need to eat the grain themselves to survive. The farmer planted anyway. His reasoning was simple. If the drought never lifts, the seed is eventually lost to taxes or desperation regardless. But if it ends, and they always do, he'll have a harvest when nobody around him has anything to sell. The drought ended. He became the most prosperous farmer in the region. Not from luck, from a clear-eyed reading of what temporary scarcity actually means in a system that has always recovered. Buying during market corrections is planting during the drought. The investors sitting on cash and money market accounts while equities are down 20% are the farmers who refuse to plant. They protect themselves from short-term pain and forfeit the subsequent harvest. Now, the third inflection point, $1 million. At $1 million, at 7%, your portfolio generates $70,000 per year in passive growth. At 8%, $80,000, the median household income in America as of early 2026 is $78,000. Your portfolio just crossed median household income on autopilot, without meetings, without commutes, without performance reviews. And if your living expenses are covered by other income and you don't need to withdraw the returns, those $70,000 compound on top of your existing million and continue stacking at an accelerating rate. Here's where the timeline becomes genuinely surprising to people who haven't run the numbers. Going from 10,000 to 1 million with 500 per month at 7% returns takes approximately 29 years. From 1 million to 2 million with the same strategy, no change in behavior, no increase in contributions, about 10 years. The second million arrives in roughly a third of the time the first took. From 2 million to 3 million, around 7 years. From 3 to 4 million, about 6. Each additional million takes less time than the one before it, because you're compounding from a larger base with every passing year. The $1 million that took you nearly 3 decades to build now gets added to your account in less than a decade, without any heroics, without any change in strategy. The snowball isn't just rolling on its own. It is accelerating beyond anything your intuition can naturally model. At $2 million, 7% returns generate $140,000 annually, more than most Americans earn in 2 full years of work. And that growth is itself compounding onto the following year's returns, and the year after that, and the year after that. This is square 55 of the chessboard. The rice is stacking at a rate the king literally cannot afford, and nobody is laughing anymore. Now, let me make this concrete with a specific scenario, because I find that abstract percentages over 30-year timelines are where people check out. Meet Daniel, 34 years old, earns $72,000 per year as a senior logistics coordinator in Indianapolis, has $11,000 in savings and about $8,000 in a 401k, $19,000 total. Completely average starting point, nothing inherited, nothing exceptional about his income or his situation. Daniel decides to get systematic. He increases his 401k contribution to 6% to capture his full employer match, about $300 per month from him, matched by $150 from his employer. That's $450 monthly going into retirement accounts. He also opens a Fidelity taxable brokerage and automates $250 on the first of each month. Total invested, $700 per month. Starting balance, $19,000. By age 42, Daniel has approximately $144,000. His portfolio generates roughly $10,100 per year in passive returns, already more than his annual contribution of $8,400. The snowball is pushing back. He has entered rotation 2. By 50, he has roughly $430,000 annual passive returns, approximately $30,100. He can absorb a layoff without wiping out his savings. He can wait for the right job instead of any job. He has options that his colleagues earning similar salaries but saving nothing simply do not possess. Then, at 58, Daniel's company goes through a merger. His entire department is restructured, and 40% of positions are eliminated in a single quarter. His colleagues at 58, with $20,000 in a 401k, an auto loan, and a home equity line they tapped for kitchen renovations 3 years ago, are in genuine crisis. They're accepting lower titles, tolerating conditions they'd have rejected at 30, taking the first offer that comes because they have no runway. One of them starts asking Daniel if he knows anyone hiring, with a tone that is painful to hear from a grown professional. Daniel takes 4 months off. He travels with his wife. He rests properly for the first time in years. When he comes back to the job market, he takes a senior role at a smaller company that pays 10% less but treats people with basic professional dignity. He had options because he spent 24 years making a decision nobody ever saw him make the automated transfer every month before anything else. The merger that devastated his colleagues was, for Daniel, a paid sabbatical, funded entirely by automated $700 monthly transfers into a boring index fund. That is rotation 60. That is what the snowball looks like when it reaches the bottom of the mountain and you're still standing. Now here is the thing, personal finance content rarely says plainly because it doesn't generate urgency or sell courses. The strategy I just described is not complex. Index fund, low expense ratio, automated monthly contribution, hold for decades, don't sell during crashes. That is the complete playbook. It fits on a napkin. You already understand it. So why isn't every financially literate person executing it? Because understanding something and executing it consistently for 30 years are not the same cognitive task. Execution requires operating against cultural pressure, biological wiring, and your own impatience, month after month, in a culture that has monetized your inability to delay gratification at industrial scale. Every advertisement you encounter is extracting money from your future and delivering it to your present in a small, forgettable package. Every car commercial is selling you someone else's definition of arriving. Every social media post from someone on a trip you haven't taken is applying low-grade pressure to spend money you haven't consciously decided to spend. None of this is conspiracy. It is incentives. Everyone is optimizing for their own outcomes. The companies extracting your money are very good at their jobs. Here's something I want to say directly because I've watched it play out across a decade of watching people around me make financial decisions. The people who build real, quiet, durable wealth share one behavioral pattern more consistently than any other. They automated investment contributions before they built their lifestyle. The transfer was set up first. The lifestyle formed around what was left, not the other way around. The people who struggle almost universally did the opposite. They established spending first, then tried to invest what remained. And what remained was always approximately zero. Because spending, like a gas in a container, expands to fill whatever space is available. The margin only exists if you deliberately create it before spending decisions are even available to consider. The financial services industry, for the record, is not structurally designed to help you do this. There's no commission in buy VTI and stop thinking about it. A managed fund with a 1.2% annual expense ratio generates ongoing advisory revenue. A Vanguard index fund at 0.03% does not. Over 30 years, on a portfolio that grows to $250,000, the difference between those two expense ratios costs you approximately $240,000 in lost compounding. Not a rounding error. A second retirement account that you paid someone else to keep. I find this more amusing than outrageous at this point. The people who most need simple, automated, low-cost investing are precisely the people being most actively redirected toward complexity that justifies fees. The complexity is manufactured to generate the revenue. The revenue is extracted from the compounding. The compounding is the entire mechanism by which you build wealth. It's almost elegant in a deeply grim way. Financial advisor tells you to diversify into actively managed funds with better downside protection. The fund has a 1.4% expense ratio and has underperformed its benchmark index for 11 of the last 15 years. You nod because it sounded sophisticated. The fee quietly removes $200,000 from your retirement account over the next 3 decades. Nobody ever sends you an invoice. The money is never visible in a single transaction. It evaporates, rotation by rotation, out of the snowball. Marcus, by the way, let's close his story. 2 years after that Monday morning reply, his portfolio crossed $800,000. At 7%, that's $56,000 annually in passive growth. His mortgage was paid off by then. Annual living expenses, approximately $48,000. His portfolio's annual growth exceeded his living expenses. Returns over expenses greater than 1. The ratio had flipped. On a Tuesday afternoon, he walked into his boss's office and said he'd be transitioning out in 90 days. He spent those 90 days doing a thorough, professional handoff, trained his replacement, documented everything, gave the company every courtesy. He retired at 53, without drama, without announcement, without a LinkedIn post about gratitude and new chapters. Because for Marcus, this wasn't a surprise. He had known it was coming for 2 years. He had simply been waiting for the math to confirm it. His portfolio continued growing after he left because his withdrawal rate was lower than his return rate. He didn't need to touch the principal. The snowball reached the bottom of the mountain and kept picking up snow with nobody pushing it. He did not need $1 million to retire. He needed his expenses to be lower than his portfolio's annual returns. Returns over expenses, greater than 1. That's the actual crossover, not a round number for the headline. A ratio. When that ratio flips, a Tuesday afternoon conversation with a difficult boss becomes a simple logistical exercise rather than a terrifying act of self-destruction. Here is your framework. 3 phases. I call them the 3 rotations because everything maps to the snowball. Rotation 1, foundation. $0 to $100,000. The hardest, slowest, most psychologically unrewarding phase of the entire journey. Your returns are small relative to contributions and barely register month to month. Every temptation to spend feels more rational than it actually is. Market drops feel personal and specifically targeted at your account. Your job in rotation 1 is not to optimize anything, it's to survive psychologically and keep the system running. Automate the contribution. Pick the boring index fund. Resist the urge to check your balance every week, and under no circumstances sell during a downturn. The snowball is small. That is correct. That is what rotation 7 feels like. Which rotation are you on? Almost certainly further along than it feels. Rotation 2, momentum. $100,000 to $650,000. Returns begin to rival and then exceed your monthly contributions. Market corrections shift from being psychologically devastating to being mathematically advantageous. You are buying shares on discount during every downturn, and you understand why. Your experience of employment shifts in a way that's hard to describe until you feel it. You have exit options that didn't previously exist, and options change behavior even when you never exercise them. Marcus didn't use his exit option for 2 more years after he had it, but having it changed everything about how he operated in that building. The snowball has real mass. Gravity is contributing. Which rotation are you on? If you're here, stay the course and let the momentum compound. Rotation 3, velocity. $650,000 and beyond. Your portfolio generates passive income that meaningfully covers or exceeds living expenses. Each additional milestone arrives faster than the previous one. Market fluctuations are noise rather than threats. You are managing an asset base rather than grinding for accumulation. The snowball doesn't need you. Your job is to stop interfering with it and let it roll. Which rotation are you on? If you're here, the hardest part of this journey is already behind you. The math takes over from here. Foundation, momentum, velocity. The entire journey from $10,000 to financial independence lives inside those 3 phases. Most people never leave rotation 1, not because the math fails, but because they quit during the phase where the feeling is wrong, even though the math is right. They walk away from the mountain at rotation 20, when rotation 50 is where gravity takes over entirely. Here are 3 specific things to do this week, not someday. First, automate a transfer today. Whatever amount you can genuinely commit to, $500, $200, $50, set it to move from your checking account to a brokerage account the day after your next paycheck deposits. Not after you see what's left, before. The transfer happens before your brain can open negotiations with itself about whether this is the right month for it. It is always the right month. The system removes the decision. Second, calculate your rotation. Take your current invested balance, multiply by 0.07, and compare that estimated annual return to your total annual contribution. If your return is below half your annual contribution, you're in rotation 1. If they're approaching each other, you're transitioning into rotation 2. If returns already exceed contributions, you're well into rotation 2, heading toward 3. Knowing your rotation removes the demoralization that comes from measuring progress without context. You're not behind. You're in rotation 12. Rotation 50 is where things change. Keep pushing. Third, identify one status expense and redirect it. Not a necessity, not something that genuinely brings you durable joy, one thing that exists primarily for appearance, social signaling, or unconsidered habit. A subscription you barely use. A delivery habit dressed up as convenience. A finance vehicle chosen partly for how it sits in the driveway. Redirect that amount to your investment account for 12 months. Then recalculate your account projection at age 60. The shift in that number is the inflection point becoming real enough to feel rather than just understand. Lazy investing built more fortune than crypto memes. The boring strategy index funds, automation, compounding, patience, zero heroics, has produced more documented, verifiable, ordinary person millionaires than every hot stock tip, every meme coin, every leverage options trade, and every course on beating the market combined. The evidence is not subtle. The data is not ambiguous. The playbook is not complicated. What's hard is executing it for 3 decades in a culture engineered to extract money from your future and hand it back to you now in the form of things you'll forget purchasing within a season. The snowball is on the mountain. You're somewhere in the rotations. The only question that actually matters now is whether you're still pushing when gravity arrives to take over.